Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Friday, June 5, 2026. We're Elena and Marcus.
Imagine logging into your trading terminal this morning, only to find out that the market's entire playbook for the next 12 months was just ripped up.
Right. It was completely rewritten in a single hour. That is exactly the environment you are navigating today.
Moving to today's data, we have extracted 4 critical themes from our proprietary updates. This will give you a very clear roadmap for the briefing.
Correct. First up is the macro shock. We are tracking a massive blowout in May non-farm payrolls that just triggered a wholesale repricing of the Federal Reserve's interest rate path.
And second, there is a severe equity reversal.
Yep.
We saw an extreme rotation out of the semiconductor and artificial intelligence trade. Capital is, shifting directly into defensive positioning.
Third, our latest run highlights a uniform commodity crush. So a systemic sell-off across hard assets driven by dollar strength and surging real yields.
Which brings us to the fourth theme, the broader synthesis. We are observing a fundamental regime shift in the market's underlying assumption.
Right, shifting from a soft landing with rate cuts to a soft landing with rate hikes.
Indeed. So let us dive straight into that first theme. The primary catalyst from our daily desk data is the labor market.
The May non-farm payrolls posted an addition of 172,000 jobs. And that just crushed the consensus on dealer desks, which was sitting right around roughly 80,000.
It is a massive miss, and it doesn't stop there. We also saw upward revisions for both March and April.
Yeah, the momentum is undeniably strong. Meanwhile, the unemployment rate just remained perfectly steady at 4.3%.
On that point, the immediate market reaction was swift. Bond traders moved violently.
They really did. Looking at today's data deck, the market is now fully pricing in a 25 basis points rate hike by year end.
Correct. And dealer desks are assigning a 60% probability to a hike as early as October.
The core assumption that you and the market held that the Fed was biased toward easing is just gone.
It has been completely inverted. And the yield curve impact was historic today.
The surge in front-end yields was really the defining feature. The 2-year Treasury spiked 11.4 basis points to 4.149%.
To put that in context for your portfolio, that is the largest single-day move we have tracked since the April 2025 tariff shock.
At the same time, the 10-year Treasury moved up 5.5 basis points to 4.532%. This resulted in what we call a bear flattening.
Understood. But applying the first principles rule here, could you break down that concept of a bear flattening?
Sure.
Like, how does a front-end yield spike actually impact a regular investor's portfolio?
It is a great question. So think of the 2-year yield like an adjustable rate mortgage on corporate America's balance sheet.
Okay.
When that rate spikes 11.4 basis points instantly, the cost of funding current operations just jumps right along with it.
Right. So if you are rolling over short-term debt to make payroll, your cash flow is suddenly impaired.
Exactly. That immediate increase in borrowing costs mechanically compresses the valuation multiple that you are willing to pay for future earnings.
The curve flattens because those short-term rates, the 2-year, are rising faster than the 10-year.
Correct. It is a mathematical signal of policy tightening fears, and the Federal Reserve context makes this even more pressing.
Moving to today's data on that front, Cleveland Fed President Beth Hammack confirmed on social media that the labor market is in balance.
Yeah, she explicitly noted that rate hikes may soon be appropriate.
Which puts immense pressure on the newly installed Fed Chairman Kevin Warsh. He faces a really high-stakes credibility test right out of the gate.
If he ignores the data, he risks inflation running hot. But if he hikes too rapidly, he risks breaking the consumer.
And that macro shock collided with a fragile setup in tech. Moving to today's data on sector flows, the epicenter of the sell-off was unavoidable.
The NASDAQ 100 shed 4.77%. And even more severely, the PHLX semiconductor index, the SOX, collapsed 10.3%.
That is its worst session since March 2020.
On that point, we can trace the fundamental catalyst back to Thursday's guidance disappointment from Broadcom.
Right. Broadcom fell another 7.9% today. For anyone heavily allocated to tech, that seeded serious doubt about near-term AI monetization.
Companies are buying chips, but are they generating the software revenue to justify the capital expenditure?
Once Friday's payrolls print hit and rates spiked, it just aggressively accelerated that unwind.
We saw a rapid contagion into the broader complex. NVIDIA closed down 6.2% and Intel plummeted 11.28%.
TSMC ADR also fell 6.69%. The TSMC chairman noted that booming AI chip demand is actually straining the global supply chain,
which presents a severe execution risk. Physical and manufacturing constraints establish a hard ceiling on near-term growth.
Indeed, and this specific weakness triggered severe global contagion, particularly in Asia.
The KOSPI pronounced Kospi-triggered circuit breakers today. It dropped up to 7% intraday.
Circuit breakers are automatic kill switches, showing just how fast liquidity evaporated. Samsung plummeted 14%, and SK Hynix fell 10%.
Our daily desk data indicates this was driven heavily by foreign investor profit-taking.
Understood. But looking at our latest run, we have to push back on the idea of a total, uncoordinated market panic.
Yeah, you really have to look under the surface here. The equal weight S&P 500 actually outperformed the cap-weighted index by roughly 120 basis points.
Correct. You should frame this not as capital fleeing a burning building, but rather moving to a safer room.
Investors are rotating out of rate-sensitive technology and hiding in defensives. We tracked heavy buying into consumer staples.
And significant flow into the insurance sector. Allstate, Progressive, Chubb, and Everest Group were all up around 4 to 5%.
Berkshire Hathaway also closed up over 2% today.
To understand why, look at insurance floats. They hold reserves mostly in short-term government debt.
Right. When the 2-year yield spikes, the interest income on that float instantly increases. They are mathematical safe havens right now.
Institutional consensus views this pullback as healthy given the elevated speculative positioning.
Though we did see record put volume in Micron options today, indicating heavy active hedging.
On that point, our desk data captured a unique liquidity dynamic out of Japan. Institutional Japanese investors were liquidating performing AI positions to free up capital.
They need that cash for the upcoming $75 billion SpaceX IPO. That acts as a massive sponge pulling liquidity out of secondary markets.
Moving to today's data on hard assets, the commodity complex experienced a uniform crush.
Broad sell-off across energy and metals. WTI crude dropped to $90.29, and Brent fell to $92.87.
Copper, which is a key proxy for industrial demand, fell 4.90%.
And silver was absolutely hammered down 8.16%.
It suffers from a dual nature. It is an industrial input and a precious metal, so it caught pressure from the tech sell-off and the rate repricing.
On that point, the price action in gold requires some scrutiny. Gold fell 3.52% today.
Right. A natural question for your portfolio is, if equities are plunging, why isn't gold catching a safe haven bid?
We have to look at real yield repricing. The dollar index posted its best day since March 13, rising 0.63%.
Because real yields spiked so aggressively, the opportunity cost of holding a non-yielding asset like gold just became too high.
Correct. When risk-free cash yields jump over 4%, cash becomes highly competitive. It overwhelms gold's traditional appeal.
Understood. Looking at the energy context, the crude decline is notable because it happened despite ongoing Middle East tensions.
Our desk data shows energy lenders are still planning around a $65.64 average price.
Which means current spot prices above $90 still embed a massive geopolitical risk premium.
If that premium evaporates, there is still significant downside risk.
Also, our proprietary updates noted Bitcoin broke below the psychological $60,000 mark, facing the same pressure as gold.
Moving to today's data synthesis, we need to connect the dots across these asset classes.
The drop in equities, the surge in yields, and the crush in commodities tells a cohesive story.
Bad news for bonds is bad news for stocks.
Correct. But looking at credit, a crucial nuance from our latest run confirms the nature of this sell-off.
High-yield ETFs, specifically JNK and HYG, actually outperformed investment-grade debt like LQD on a price basis.
Right. Investment-grade corporate bonds carry significantly higher duration, meaning they are more sensitive to interest rates.
The fact that they underperformed proves today was an interest rate duration shock.
It was not a credit default panic. Investors are not forecasting bankruptcies in the CCC or Baa space.
We see the stability in private capital. Despite the public market carnage, Apollo and Blackstone finalized a $35 billion debt package for Anthropic.
Indeed. Private credit markets remain wide open for AI infrastructure. The long-term CapEx thesis is intact, shielded from the daily volatility of the 2-year yield.
This brings us to the new macro regime. The market is aggressively repricing tail risk.
We are no longer assuming a soft landing with rate cuts. The new regime is a soft landing with rate hikes.
The labor market is accelerating, adding 172,000 jobs. But persistent inflation, driven by high energy costs, is forcing discount rate assumptions upward.
You have to calibrate your portfolio to a world where capital costs are rising.
Leaving you with a final thought for next week. If the front end has already violently repriced, keep a close watch on the 30-year yield.
Right. If the long end breaks above the psychological 5% barrier, it could signal a deeper fiscal and inflation premium dynamic that risk assets haven't fully digested yet.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back next week with the latest market color. Have a great weekend.